Hi friends, today I'm going to talk about a very important topic that's about how to plan ahead in a rising inflation scenario. So all of us are confronted with these high interest rates, and also it's very important to get some perspectives as to how do we protect our capital and where should we park our money, and how do we get some real returns which are adjusted for inflation. So there are some very important concepts surrounding this inflation and the investments around certain class of asset stuff and kind of stuff like that. I'll share a few things on that. Okay. So this is my Vantage Points second session. So let's get started. Okay. Now, a lot of guys will get stuck in a rising inflation scenario, and what is called as savings-led stagnation. Okay. It's not about equity, debt, or real estate, gold, or other assets. It's about beating the inflation rate in the long term, right? And that's very important. Let me explain with one illustrative example. Okay. Now there are two friends. Both have got about 5 lakhs each to invest. They were thinking of buying a house, but both of them decide that they'll save some for the future, and then after 30 years, at the time of retirement, they want to buy a house. Okay, and then live happily. So one guy invests in the equity class of assets. Okay, the other guy invests in bank FDs, 5 lakhs each, and the rate of return for from equity markets at the index level historically has ranged between 12 to 15%. So I've taken a lower return scenario, and bank FDs literally mirror the inflation. So I've done enough research, 36 years data, and I've analyzed. So on long-term inflation in India is about 7%. Okay. Now, if at these under these assumptions, if both hold it for 30 years, the net worth of the guy who has invested in equity is about 1.5 crores, vis-a-vis 38 crores of the guy who has chosen the bank FD route. Now, what does it mean? There is a 7% FD, there is a 12% index returns, and there is a 7% inflation. That's the scenario, right? Now, you got additional 5% over a 30-year period would actually translate to about 111 lakhs more in terms of your purchase power as compared to the person who has stayed put with FDs with literally loss of purchase power. Now there is a small formula here. It's not between 12 and 7 is not the real returns. It's not the nominal minus inflation. Nominal returns minus inflation is not the real return. It's actually 1 plus nominal rate by 1 plus inflation minus 1. So roughly it's about 4.67%. So nevertheless, the guy who has stayed put with index investing in stocks has got about 4 times increase in purchase power, vis-a-vis no change in purchase power. So if the both guys now decide to buy the same house of say 5 lakhs, which they wanted to buy but postponed their decision to buy, the guy who has put it in FDs will still have the same house at 38 lakhs with no money in his retirement coffers. But the guy who has stayed with investing has saved at least a crore plus, which besides buying probably that one house which cost him the same as around 38 lakhs. So that's a simple example. Now, some very real life example, I just got hold of this. It's forwarded many times in WhatsApp. Somebody got a bill from Kirana stores on 19th May 1971, and the family bought few kgs of tur dal, green gram, urud dal, cooking oil, sugar, and stuff like that. The left side is all written in Telugu, but I've translated that into English here. And the current price, if you take a ballpark estimate on Amazon and other sites, there is an increase of, for example, green gram price by 100 times in over a 51 period as of today. That roughly translates to about 9.44% increase in consumer prices of certain of these items. So this is only illustrative, but it just shows that yeah, there could be around 7, 8, 9, 10% inflation. So essentially, we are that's the big thief. So inflation is the biggest thief we have in our lives, right? So we need to just be careful of this and protect our assets and capital. Now, investing at even slightly higher rates of return above the inflation in the right asset class can generate significant long-term wealth than we can think of. That's the message I just wanted to share. The tagline can be like, we should ask ourselves, how do I move from savings-led stagnation to investment-led growth? So for that you need to ask yourself, so what's your asset allocation framework, right? Now, for that, you need to recognize what are the typical asset classes we have: equities, gold, bank deposits, property, highly location specific, bond funds. Average inflation is about 7%. So, we need to beat at least part of our money should give above average returns as compared to inflation. That's the sum and substance of what I've said. To sum it up, there's one very important slide that I'm going to share in the next slide. There's a famous investment. He's one of the top investment gurus in USA. His name is Mr. Ray Dalio. So he has come up with a classic framework as to how do we beat this inflation. So through multi-asset investing. It's called all-weather portfolios. I would strongly recommend that you read some of his books. So that's the minimum I can do to in picking up his perspectives. Okay. Now, for him, the whole world is one economic universe, right? And he has crystallized, and there are only two dimensions as to how you will analyze the global economy. There is a scenarios. There are only two-dimensional analysis. One is inflation. The second one is growth, economic growth or GDP, whatever we call. So you should look at the world from an investing perspective on these two dimensions. So, and the inflations and growth, they keep moving in cycles. So first you may have a rising inflation scenario like what we are confronted with now. We have ended a low interest rate cycle scenario which ran for several years for us. As we all see, they hit the rock bottom, but now they are going through the roof. So we are definitely in a rising inflation scenario. Rising growth, some markets like India and all may be in a rising growth scenario. Some markets like probably UK or even Japan and all may continue to be in a declining growth scenario. So the asset classes that you need to buy or invest in are different in different investing markets. That's the key message. Okay, depending on where you invest. Now, if it is a rising inflation and rising growth, something like very similar to India, stocks, commodities, real estates are likely to do well. That's very important to note. Similarly, if it is a rising in another market, there is a rising growth, the GDP is rising, but the inflation is falling, which means essentially they are getting converted from developing countries to developed economies. So what happens then? Real estate, stocks, corporate bonds, emerging markets. So which means the investments will move away from developed markets to developing markets. That's one investment strategy. One should look at it. Similarly, if it is falling inflation and then falling growth, then it's like a stagflation, right? Either ways you are not growing. So that means it's government bonds and precious metals. Whereas if it is rising inflation and slow growth, then it could mean just precious metals. So this is the indicative framework in which he has done a massive correlation running into several hundreds of years. I consider him as my role model or someone to look upon with great respect, Mr. Ray Dalio. So that's the source. I've acknowledged his wonderful contribution to enable us to understand these economies far better. Okay, so that's what I wanted to share in today's session. So I'll continue this in the next session with my Vantage Points 3, wherein I'll take you through. Let's pick up one asset class which is government bonds or the long-term debts, and then see short-term, medium-term, long-term. How do you start your fixed income strategy kind of a thing? So this is for the people who don't know about me. Okay, so I'll just run through this slide. So suffice to say that I've recently got this equity research certification also in place. So that's about it, friends. Thank you so much. This material is prepared for educational purposes, so all the standard stuff applies in terms of all the investments in capital markets are subject to business and market risk and may lose value. So just take care, do your own due diligence before investing. Thank you so much.